Hey everyone, and welcome. Let's be real, money can feel super complicated, right? But it really doesn't have to be. Today, we're going to pull back the curtain on 10 key financial ideas that pretty much run our lives, whether we know it or not. So let's dive in.
We have all had this moment. You bust your butt all month, you see that glorious payday notification pop up on your phone, and you feel that rush. But then, you click on it, you look at the actual deposit, and the number is smaller, a lot smaller. And you're just left staring at it thinking, wait, what just happened?
It's the $1 million question, right? Or in this case, the $544 question. Where did all that money go? It feels like it just evaporated. But it's not magic. There are these huge, kind of invisible systems at play, and today we're going to make them visible.
Okay, so let's follow the money. Where does it actually go first? Well, before you even get a chance to spend a dime, it's already making a couple of mandatory pit stops. And the first two are the government and, you guessed it, the bank.
So that first huge chunk that just vanishes from your paycheck, yep, that's taxes. The easiest way to think about it is like it's your subscription fee for living in a functioning society. That money is what paves the roads you drive on, funds the schools your kids might go to, and pays for the safety inspections that make sure your favorite food truck doesn't give you food poisoning. It really is the cost of civilization.
And it's not like it's just one single tax either. Oh no, there's a whole family of them. You've got income tax on what you earn, sales tax on pretty much everything you buy, and even capital gains tax when your investments do well. Then you have Social Security and Medicare. Think of those as a forced savings plan for your own retirement and health insurance for the older generation. It's a whole ecosystem.
All right, so whatever's left of your paycheck finally lands in the bank. Now, I think a lot of us imagine the bank is like this giant vault from a movie, where our money is just sitting in a pile with our name on it. But that's not how it works. Not at all. A bank is actually more like a financial matchmaker.
So check this out, because this is where it gets really interesting. The system is called fractional reserve banking. Let's say you deposit $1,000. The bank doesn't just lock it away. Nope, they only have to keep a small piece of it, a fraction, maybe $100. And the rest, that $900, they lend it out to someone else who's buying a car or starting a business. So get this, they are literally making money with your money, all while your account still shows that you have a full $1,000 ready to go. It's wild, but that's how money actually moves through the economy. All right, so we've tracked where your money goes right off the bat. But beyond that, there are these other unseen rules of the game that really decide what your money can do for you. Let's dig into the concepts that truly govern your financial power. And man, this slide just nails it. Interest has two completely different personalities. When you owe money, interest is your worst enemy. Seriously, it's that slow burn that turns a $12 burrito on a credit card into a $50 regret. But when you're the one earning the interest, it becomes your best employee. It works 24/7, no breaks, just quietly duplicating your money like a cheat code in a video game. It all comes down to one simple question. Are you paying the interest, or are you collecting it?
Okay, let's talk about your credit score. This little 3-digit number, it is one of the most powerful numbers in your entire financial life. But here's what most people get wrong. It has nothing to do with how rich you are. Nothing. It's a grade on how trustworthy you are. It's a lender's simple way of asking, hey, if I loan this person some cash, what are the odds I'm going to get it back?
So how do they calculate that trust score? Well, this chart breaks it down perfectly. You've got a few things in the mix, sure, like how much of your available credit you're using, but just look at that massive piece of the pie. Payment history. More than anything, and I mean anything else, lenders just want to see that you pay your bills on time. Every single time. That consistency is the absolute bedrock of a great credit score. And the difference this score makes in the real world, it is huge, like night and day. With a low score, you're basically a walking red flag to lenders. That means you're going to get hit with higher interest rates and have way fewer options. But with a high score, suddenly you're sparkling with adult credibility. You unlock the best rates, you get more choices. I mean, this can literally save you tens, even hundreds of thousands of dollars over your lifetime on things like mortgages and car loans. It's a big deal.
All right, let's zoom out for a second. Because beyond our personal finances, there are these massive economic forces out there that affect every single one of us. You can think of them like the weather. You can't control if it's going to rain, but you can definitely grab an umbrella and prepare for it.
And the first big weather system is inflation. You know that feeling when you buy a bag of chips and it feels like it's half air, but the price somehow went up? That's inflation in a nutshell. Your $5 bill is still technically a $5 bill, but its actual purchasing power, what it can get you, has shrunk. It just doesn't stretch as far as it used to. So why does this happen? What's actually causing it? Well, it's usually one of a few things. Sometimes it's simple supply and demand. Too much money in the system chasing not enough stuff. Prices go up. Other times, you have supply chain problems that make everything more expensive to make and ship. And then there's this really fascinating psychological part. If we all think prices are going to rise, we all rush out to buy stuff now, which, you guessed it, actually causes the prices to rise. A weird, self-fulfilling prophecy.
And all of this fits into the bigger economic cycle, which, I love this analogy, is kind of like a party. First, you've got the boom. The party's raging, drinks are flowing, everyone's having a great time. Then you hit the peak. It's like last call at the bar. The lights start to flicker. And then comes the bust, or a recession. This is when the party's over, the bright house lights are on, and the DJ is playing sad songs about downsizing. It's a bummer for sure. But it's not the end. It's just the cleanup phase, the reset before the next party starts all over again.
Okay, we've covered taxes, banks, and these huge economic forces. And I know that can all feel a little overwhelming. But now we get to the good part, the empowering part. Let's talk about how you can take all this knowledge and actually put your money to work for you, to build the future you want.
And your number one weapon in this fight? It's investing. If inflation is the slow leak in your financial tire, investing is the pump that keeps it full. It's how you stop your money from just sitting there and turn it into an active employee that goes out and earns more money for you.
And you've got a ton of ways to do this. You can buy stocks, which are basically tiny little slices of ownership in a company. Or you can buy bonds, which is like you loaning money to the government or a big corporation, and they pay you interest for it. And if you don't want to pick and choose, you can buy funds, which are like pre-made baskets of stocks and bonds all bundled together. The point isn't to be an expert on day one. The point is just to get in the game.
But what's the secret sauce behind all of this? What really drives wealth? In one word, value. At its very core, making a lot of money is about creating something, a product, a service, an experience, that other people decide is incredibly valuable. That's it. That's why a luxury handbag can cost 100 times more than a basic one. It's not about the leather, it's about the perceived value. And this leads to maybe the most important point of all. Building real wealth is not a lottery ticket. It's not a get-rich-quick scheme. It's a marathon, not a sprint. It takes patience, it takes consistency. You have to give that unpaid employee compound interest, the time it needs to work its magic over years, even decades. It's not about timing the market, it is all about time in the market.
Which brings us to our final and honestly our most important idea. Think about it. You can always find a way to make more money, but you can never, ever get back your time. It is the one asset you have that is absolutely positively non-renewable. So the real question I want to leave you with is this. Now that you know all this, how are you choosing to invest your time?